Thank you, everybody. We really appreciate you coming back after lunch, and we have two more panels to share with you, continuing our conversation today about the future of consumer protection in the financial services space. We have a really staggeringly accomplished panel that's agreed to join us. And I'll just do very short introductions to try to preserve time for them to speak. Each of them, I think, has a long list of accomplishments that I'm not going to do justice to. But beginning down on the far end, Commissioner Darryle Rudy is the commissioner of the Utah Department of Financial Institutions. He is the primary regulator for all banks and financial non-banks for the state of Utah, and is reports to the governor of Utah. Also, 35 years in the Utah department, working his way up from a line examiner all the way to being in charge of the agency. Been a stalwart presence in Utah financial services for a generation. My colleague Ryan Christiansen has a long and distinguished career in the financial services industry, but is now no longer a businessman, but is an academic. He's the executive director of the Stena FinTech Center, which is a center within our Eccles College of Business here at the University of Utah, focusing on trying to bring financial technology to the marketplace and educate our students in the business school about the best practices in the fintech world. And then immediately to my left is an old and dear friend who has kindly come, even though he has way too much to do. Seth Frotman is the general counsel of the Consumer Financial Protection Bureau, the top lawyer in the CFPB. Before that, he was the founder and executive director of the Student Borrower Protection Center, a leading nonprofit focusing on consumer rights in the student loan space. And prior to that, he was the second student lending ombudsman following Director Chopra at the CFPB. He was also a special advisor to Holly Petraeus, who was the assistant director for service member affairs at the CFPB, and spent many years working on trying to ensure service members and veterans are treated fairly and in the marketplace. And then to my right is Erin Witte, who is the Consumer Protection Director at the Consumer Federation of America. Erin is also a former enforcement assistant attorney general in the Virginia office of the Attorney General's office, has a long and distinguished track record in bringing consumer protection enforcement cases, and now is one of the primary consumer protection advocates in Washington, D.C. Well, I have a couple of questions that I've started to have and have asked them to share with me. But the first thing I wanted to do in this panel is to just let each of them take a few minutes to talk about what's on their mind. But to set the stage, this panel, we wanted to focus on something called embedded finance, which is kind of a weird name. And I think it's a bit abstract. A lot of people won't know what we're talking about. So let me just set the stage. Embedded finance, what people mean by that is the notion that that more and more non-bank companies, non-financial services companies, are trying to build in financial services into the product or service offerings. So just give you a couple of examples. Ticketmaster, the company that sells tickets to concerts and events, they also sell insurance in the event that you can't go to attend your conference, or if the concert is canceled. You could buy an insurance product while you're buying a ticket. It's an example of embedding a financial service inside an app that has really nothing to do with financial services. It's about going to concerts. Another example would be Elon Musk, the wealthiest man in the world, has announced that Twitter this year, we'll see if that really happens this year, but it's coming. Twitter is planning to adopt a comprehensive payment mechanism where people, not only can you, not Twitter, I should say X, I'm still struggling to change the name of the social media company. Not only can you, send out social media messages, he's explaining that you're also going to be able to make payments to other peer-to-peer payments across the Twitter platform. So if Seth owes me some money for drinks, he could just tweet it to me as opposed to actually paying me cash. cash. It's embedding a payment system into one of the most important social media companies in the world. eBay, DoorDash, Uber, a whole host of different software companies and even car companies are trying to find ways to monetize, get extra revenue into their business model by coupling whatever it is that they're selling with some financial services product, a payment mechanism, a loan, an insurance product, or even an investment vehicle. And maybe there's a lot of advantages to that, but there also could be some potential consumer protection challenges. How is the regulatory environment going to shift? What potential pitfalls could exist down the road? And these are massive changes in the economy. And I just want to talk about like how it is that we're going to make sure consumers get a fair shake in all of this. So with that, I'm going to just, if I could, just have us go down the row, starting from left to right. Commissioner Rudy, would you start us out? What's on your mind about embedded finance?
Well, yeah, it's a rapidly changing marketplace in the current environment, but it's nothing that hasn't been around for years and years. I mean, I think of, you can look at our depository institutions that partner with many fintech companies. That could be considered some portion of embedded finance. And
could you speak into the microphone?
Oh, sure.
People have a mic in hearing.
Sorry. And, you go back 30 or more years, many depository institutions that weren't offering some products and services because of either the lack of technology within the bank or they just didn't want to take on that risk directly. And I'm talking about like mortgage loans, credit card loans. It was a different software system to calculate the interest on that and keep track of them. So they would sub that out to other companies and partner with them. And you bring that forward 30 years and now you've got all these partnerships with different products and services that consumers want in a very rapidly developing marketplace. And so for us to keep up with all that and stay ahead of it, or at least break even, is a big challenge in our world. And there's other products and services that still haven't maybe come full circle with the banks yet, like the buy now, pay laters, the earned wage access, cryptocurrency, and even gold. So we're looking at how we deal with that going forward, how the federal agencies are doing that. I should say we partner with all the federal or many of the federal agencies. The FDIC is our closest partnership. Our banks and depository institutions, industrial banks and credit unions have to have federal insurance. So it's NCUA for the credit unions, it's the FDIC for the banks and industrial banks. So we partner with them, do joint examinations, do joint compliance examinations. We did one of the first joint compliance examinations with CFPB at one of our largest institutions at the time. And we also partner with the Federal Reserve. And back in the day when the OTS was around, we partnered with them. So as they are developing their methodology of examining for these new products, it appears to me that they're stretching some of the rules. And some of the panels earlier today talked about the rulemaking and the Chevron doctrine of, have they stretched the rules too far? Will they be challenged in court? Will they be overturned? Those are all things yet to be determined. From our perspective, we like to be the adult in the room. We like to have firm but fair regulations applied to our institutions. We don't like to see that pendulum swinging too far one way or the other. We have that magic middle we like to stay in. So when those rules are changing and evolving, sometimes the institutions are, pushed into a new realm of rules that the agencies have taken advantage of, and maybe they haven't played their way out through the court process. So I hate to just see those things being developed without a lot of thought put into them by the agency heads.
All right, what am I thinking about? A couple of things that I'm thinking about in terms of especially embedded finance is, one, this seems like a bit of a natural evolution as we've watched the number of banks in the country really rapidly decrease. We've gone from over 12,000 banks in the 90s to just over 4,000 today through both consolidation and just lack of new charters that are coming on board. And so you also have, at that same time, technology starting to increase and become more prevalent. And so it seems a bit of a natural evolution for technology to step in and say, how can we embed some of these financial services that are, in a sense, getting more consolidated into the larger players into our services and you know, find some ways to make some additional revenues off of that. I think it's done some incredible things for us. I always like to joke that you know, the financial institutions had 40 or so years to figure out how we could split a bill over lunch, and the best we'd come up with was a check. And so it took some innovators to come along and say, maybe there's a better way, but you know, I don't think that everyone's kind of fully thought through some of the protections and the regulatory oversight that comes with that. The things that, you know, obviously everyone's keeping an eye on right now are sponsor banking. That's where a lot of this is occurring, and we've seen some real challenges with sponsor banking. A lot of consent orders coming through. We obviously have the Synapse Evolve dumpster fire, and so there's clearly some lessons that need to be learned, but how do we continue to provide the competition that we've talked about today as well to consumers with their financial services?
Great. And I'm so happy to be here, Chris. Thank you for inviting us. And I think first off, I think Hal was wrong that he said the second panel was going to be the most important and exciting panel. I think it's definitely this one today. So I was thinking about this on the plane over, because that's when I prepped, obviously. So I want to take you guys back to an ancient age, a long, long time ago. The year is 2010. The Dodd-Frank Act has just passed. The iPhone just turned 3. If you were ordering a pizza from Domino's, you probably called it in and then drove your car over and then paid with cash or maybe swiped a credit card. The app-based economy was just in its infancy, including the Consumer Financial Protection Bureau, and the idea that all of these technology companies were out there imagining electronic disruption would shape all of our lives was just this infant dream. 14 years later, the world is obviously profoundly different. I was trying to think of the hypo that was both realistic and pretty comical, so here goes. So on any given day, you're waiting at Starbucks for an order you just paid on your app after having just left your dentist's office after being sold a new medical debt credit card. As you stand there, you may be wondering why your auto dealer you visited last week tried to sell you an add-on product that turned your car into an e-payments platform, or why the search engine is advertising that you could keep their money in a digital wallet. You might think ahead to how you have to pay your rent, not through a check, but through a new payment site that your landlord uses. That platform charges you a $15 fee every time you want to make your loan. And that reminds you, you keep getting stuck with these junk fees every time you have to pay off your kid's school lunch. As you're sitting there, your mind reels and you realize it is definitely not 2010 anymore. And I think what we see across this is, again, as Chris mentioned, how consumer finance has really overtaken so many aspects of life that we never used to think of as not being a bank or not being a financial transaction. And I think one of the points about this isn't by accident. I think you see kind of the top leaders of Silicon Valley talk about embedded finance as really the future. I think one of the quotes we had from one of the top VC firms in just 2020 said, quote, "In the not too distant future, nearly every company will derive a significant portion of its revenue from financial services." Another talking about how by the end of this decade, embedded finance could drive nearly $400 billion a year in annual revenue. I think a lot of this, which we'll talk about today, I think is driven by the rise of big tech, A lot of this is driven by the rise of digital payments, especially after the pandemic. And a lot of this, I think, is driven how online marketplaces have really become a dominant form of commerce in this country. And I think the question for all of us as regulators and policymakers, you could see why it's obvious that while many companies want to be in consumer finance, that is a lot different question about whether they are able to comply with the consumer financial protection laws. And I think that really is the challenge for all of us. So I think a couple big ideas that are on my mind is the consumer financial protection framework and infrastructure we have in place now ample to the task? Ample to this idea of sitting in your car making payments through your car, through your phone. What does that mean for the tools and resources that we have as regulators and law enforcement officials to make sure that people aren't being taken advantage of? I think the second thing is the extent to which these entities use the relationships they have built on the non-financial sector or through the platforms that they exist on to take advantage of or to leverage those relationships to the detriment of consumers. And I think the third is a real national conversation, which I think we need to be having about the blurring of the line between banks and commerce, and whether or not we have already far surpassed what we had thought was a pretty golden rule about trying to keep those separate, or are we too far gone from that as well? Erin?
Yeah, I think this really resonates with me as I was preparing for this panel. And I want to sort of push back on one of the first things that Commissioner Rudy said, which is that, this has been around for a long time, right? We've always kind of had this blending, but I don't necessarily agree with that. I think we have a pretty strong American history of not necessarily blending these two aspects of our economy, right? Actual commerce and banking. So when you look up embedded finance, or when you're starting to look into this issue, what you see are a lot of tech companies that are talking about the benefits. This is the wave of the future. But then, I started looking a little bit more closely about what benefits they were describing and what terms they were using to show how great this really was. And the word that I kept seeing over and over again was, it's frictionless. It's seamless. You are catering to your customer base. This is the idea that a consumer doesn't have to leave your app or your website to buy something. So in theory, it's easier or faster or more convenient for the consumer. But frictionless also means that you are naturally removing some inherent resistance to something, right? You're wearing somebody down in a particular way. And I don't know that that's always a good thing. We're going to talk a lot about what the risks are and kind of what is happening. So even though this process is getting faster and more seamless and more frictionless, there's a lot going on in that frictionless process behind the scenes. And, my job as an advocate and sort of my background as an attorney when I used to represent individuals is to really think about this from the lens of what the consumer is experiencing and what they're seeing and what they're not, and what they have traditionally understood about buying something, right, participating in commerce, and then being immediately provided with like a financialization of that product. So what does this look like for consumers? What do they see? What do they know? What do they understand? And how can we sort of tease this out and say, what is happening and how do we address that? We've talked about payment mechanisms, and there are these peer-to-peer payment providers. This started out as a way to just make it easier to split a check. But this has morphed into much more than that, right? This has morphed into digital wallets. People are holding billions of dollars in these digital wallets. And there's a real question about what happens when that company fails. They're often not FDIC insured. The CFPB has talked about this quite a bit. But there's some real risk there. And there are populations that are going to be disproportionately affected by those failures. Service members have filed tons of complaints with the CFPB about problems with peer-to-peer payments. Low-income populations, when companies advertise these products, they say, well, we're serving people who are not banked, we're giving them an opportunity here, but we have to think about what the impact is and what the risks are when those people rely on those companies to act like a bank, to be as responsible as a bank when they're acting like a bank and they walk and talk like a bank. We're probably going to talk about buy now, pay later products, right? You're going through a purchase process and then you get hit with the option to finance that purchase. embedded finance within an app. And, I just want to point out quickly, we don't have to spend too much time on this, but there's another aspect of banking activity that happens with things like airlines. There's been a lot in the media lately about airline rewards programs where people spend a lot of money with a particular airline. They use a particular credit card because that airline has promised them rewards. But those rewards are this like fake currency that an airline made up as a way to keep people with their business. And there are questions about what happens when an airline unilaterally and retroactively devalues those points, this currency that people have come to rely on and really invest in, these private regulations that airlines put over the spending and what happens with those rewards. But it's just sort of an example of how non-banks are just pushing and pushing and pushing their way into this financialization of our economy. And there are questions about the harms and the risks for consumers.
Well, thank you, everybody, for your introductory sort of comments. I'm going to start us out with a question that I have. And I also want to invite folks from the audience to chime in, too. I've got my Slido app up and running. I know it's I don't know if it's the best way to do it, but I want to make sure that folks that are watching, because there are more people watching online by far than are here in the room with us, and I want folks to be able to chime in. So don't hesitate to do so. I see somebody's already put one question in, and I'll try to make sure we circle back. But let me just give you a hypothetical that it's a hypothetical, just making this up, but it seems to me to be quite plausible. And let's imagine a three-party business joint venture between a bank that's a fintech-oriented banking as a service bank that partners with a fintech company, and that fintech company provides relatively high-cost loans. Legal, generally speaking, here in Utah, very illegal felonies in the state of New York because the interest rates are higher than the New York interest rate caps. But because it's made by a bank, potentially it can be exported across state lines. And then third, let's say there's also a online sports gambling app. And this sports betting app allows you to make bets in real time on football games or basketball games or whatnot. And let's further say that the fintech company has permissioned API access to tunnel into the consumer's bank account and knows what their bank balance is. They know what their transactions were, when their next payday is. And then they come up with an algorithm, a model that predicts when it is that people are going to be most likely to double down on a bet that's maybe going sour, and even potentially borrow money at high cost and have a really good sense of whether or not that person is likely to make the bet, borrow money to do so, and whether or not they can pay back, maybe not just pay back, but pay back ideally very slowly, where there's a lot of interest that you have to pay in order to pay back that loan. I just made that up. But that strikes me like that is a strikingly plausible pathway that we may be talking about. And my question for anybody that's willing to weigh in on the panel is, that legal? Are we good with that? Is it permissible? And are we okay with that as a society? Folks?
Well, we started out with an easy one, guys. Well, this is a little tricky, but I think that it reminds me a lot of Director Chopra's comments earlier about when a company is created for the purpose of regulatory arbitrage. Now, you've used two financial institutions, one of which is subject to a rate cap and one of which is not. And what is the purpose of that relationship? Was it really to provide these services to somebody? Was it really to help someone in need? Or was it to actually avoid an interest rate cap? Was it to evade usury, a really critical protection for low-income folks and people who shouldn't be abused? So I'll say that. Then you're coupling this with this really powerful thing that happens every day, which is data harvesting by these companies. I said in the beginning of my comments, what do consumers know? What do they understand that's happening in this frictionless experience? I would venture to say that most consumers don't know that this is the information that's being taken from them, used to develop an algorithm that can abuse them, right? Hit them at their hardest when they are down low and, when they have a demonstrated proclivity to maybe be a little bit more risky, borrow that money at a higher interest rate. So, I don't know if I can really answer the question of whether it's illegal, but I do think that it reminds me similarly of a case that the CFPB is currently litigating against a subprime auto lender that developed an algorithm to develop a price for a vehicle that was secretly inflated and hidden from consumers that allowed the lender to profit while many, many, many of its consumers failed. So it's sort of taking advantage of this informational asymmetry that exists, right? That's what abusiveness is all about. We heard about that earlier. This taking advantage of this informational asymmetry between a really powerful company who has access to all of your data, you may not know that they have it, and then what they decide to do with that and how they're going to profit from it.
I'll weigh it in.
Please.
What I'm hearing is probably a few things. I think there's a question about DIDMCA, which is the ability to export some services across state lines. And
Let me help. So the DIDMCA is the Depository Institutions Deregulation and Monetary Control Act of 1980, and it says that a state chartered bank in one state can apply the bank's home state interest rate cap to the borrower's home state. So you can export the lack of an interest rate cap across state lines.
Correct.
Go ahead.
And that's actually actively being litigated, and so I don't know if that's
Two states have opted out, Colorado and Iowa, and it's not clear. And there's a lawsuit about whether or not Colorado can permissibly do that. But yeah.
So I guess my answer to that question is I think it's an open question, and it seems to be making its way through the process of answering that question. And I think there's some really legitimate arguments on both sides, quite frankly. But we're in the process of figuring that out, and I think that's why it's a good question. There's also the question of a consumer permissioning their data through open banking, which is the ability to import your data from your bank account into an app. The CFPB has a notice of proposed rulemaking on open banking that says secondary uses of that data is not permissible. Now, that's a notice of proposed rulemaking. It's not final rulemaking. If that ends up in the final rule and the app is not explicitly saying that we're going to use this as a way to figure out when you've made a bet, if the primary purpose was actually just to connect your account so you could transfer to this other use, to make a bet, and the secondary use was to do something else, then you would be outside of the rule at that point, and that would be a problem. But again, this is a notice of proposed rule, and we don't have the final yet. So I think the question is a good one in the sense that there are a lot of things that are happening right now that are possible that we're trying to figure out, and we'll see. But I think that ultimately giving consumers the ability to make choices is good, but having the protections wrapped around that is the right approach.
The government officials don't have to answer if they don't want to. You're not under subpoena.
So I'm going to stay away from the actual question. It's a very long poll, but I think that Chris's question forces us to think about a bunch of different issues as it relates to embedded finance. I think one of the issues the hypo really raises, which we see across a range of products, which is I don't think that we could take the idea of instant access to credit at point of sale as a universal good. Right. And I think that we as policymakers, as regulators, as academics need to think really hard about that question. I think another example where you kind of see kind of the same color in the hypotheticals is around the first panel and medical debt. I think in a lot of ways you see this issue and this debate come up around people who go for medical care and on the doctor's chair or dentist chair or in the doctor's office wind up getting care in exchange for an exceedingly high cost credit product. And I think one of the questions, there's obviously multiple sides of that, which is this person needed the care. This is how they were able to access the care. Isn't this good? I think when you take a step back, I think that really calls into question fundamental issues around, is access to credit a universal good? Should we be looking more at the interest rates that people were offered? Should we be thinking about maybe credit here isn't the actual thing we should be substituting as a society? And I think this is like one of the fundamental questions we see around embedded finance is this idea of creating liquidity through high cost credit. Is that something that we should be encouraging? Is this something that we should be worrying about? I think the other issue that we continuously raise is really focusing on the ways that companies are able to monetize a product where something didn't exist before. So, one of the questions that came up for Director Chopra was around rental and tenant payments. And one of the things we're hearing about all the time now are rental payment platforms. So, a long time ago, you used to be able to just pay your rent with a check and it was free. And we're hearing more and more from people on the road, including lawyers representing really low-income clients, that a lot of the apartments, especially the corporate-owned apartments, have moved to mandatory use of a rental payment platform. So you have to pay for your rent online with fees that we've heard in $15, $40. A lot of times, additional fees are built in to the actual bill that someone owes, but you can't pay less than the full amount on the rental platform. So you either have to pay the fees or go behind. And I think this is like a real question, which is this really an advance where the companies who do this obviously have to make money? And a lot of that stuff is being driven to the most marginalized people in society. But is that taking advantage of that friction to drive fee revenue? Is that a positive development? I think that was my way of dodging the question.
Well, maybe I could slightly alter it for Commissioner Rudy, because there are differences in the way that a State Department of Finance or financial services regulator would regulate or would supervise a bank versus a non-bank, just a registered company or maybe a company that has a particular license within a special usury statute, and then maybe, or not even at all, or potentially a service provider or a partner that's a company that's originating or facilitating the financial services that are being provided by those two, in my example, the bank and then the fintech company. And could you just tell us all a little bit more about how it is that a state banking regulator would ensure compliance with existing consumer protection laws, things like prohibitions of unconscionability or deceptive trade practices or just outright fraud or other harsh practices for each of those different types of businesses?
Sure. So our department's kind of structured into two major units. One is the depository institution unit, which is banks, industrial banks, credit unions. They're required to have federal insurance. So we have a federal partner on most of those jobs with us. And those are examined on a regular basis, could be annually. For the largest banks, we have many exams during the years focusing on specific areas. And the smallest ones, we might only go in there once every 18 months. But it's a very rigorous process. We're looking at safety and soundness of the institution, how well it's managed. We have a CAMELS rating that we assign to the risk profile of that institution. And in addition to the safety and soundness exam, we have a separate compliance examination that looks at all the compliance rules, regs, disclosures, and how they interact with if they have partnerships or third-party partners. Because the bank's responsible for those partners, just as if they were doing the lending themselves. So we look at those contracts, we look at the agreements, we look at the due diligence, the marketing materials. It's a very in-depth process. And, first we look to the institution, what are you doing? And what are you allowing your partner to do for you? And so if we can't get it from the bank, we'll go to the partner and look at those contracts or the processes. We transaction test to make sure they are following the rules, the disclosures, and the compliance laws, rules, and regs. So that's on the depository side. On the non-depository side, where we have money transmitters, check cashers, DDL lenders, whatever, that's more of either a license, a notification, or a registration. That process is primarily driven by consumer complaints. So if we see a pattern of one institution that's getting a lot of complaints in a certain area, we will follow up on that. But primarily, we're looking to match the consumer with the company to try to resolve the differences because sometimes it's just a misunderstanding. Sometimes it was, we'll look at the contracts, say, was it disclosed correctly? Was it prominent in their disclosure like the federal law requires? And if it's not, we have a problem with that lender that's providing that credit service. So that's kind of the basics, but for depositories, it's a much more rigorous process that they go through because they are a depository. They have the power, or they have consumers' funds, and then they're lending those out into programs. So we're looking at both sides of the balance sheet, and we want to make sure that the consumers are protected.
Great, thank you. Maybe this also, in response or in conversation with that question, Ryan, I'm wondering if you would talk with us a little bit about, I think it's a fair point that as technology is just reshaping the world, these legacy categories of financial institutions and legacy regulatory and legal systems, they seem a bit antiquated, and I fully confess that. And it seems to me like you're in a good spot to talk about, what kinds of evolution in the financial services regulatory oversight would be better adapted to try to deal with a rapidly, changing information technology ecosystem for financial products. Would you? I think this is. Would you want to speak about that?
Yeah, sure. Yeah, sure thing. I can give an example of some experience that I've had with a fairly old regulation and how it applies to today's technology. When I was with a company by the name of Finicity that was later bought by MasterCard, we were using open banking data, so the ability of consumers to connect their accounts to apps, to assist with verifications of assets and verification of income for mortgage underwriting purposes. So rather than taking in or emailing your statements to give to a lender, you could digitize that process and do it in a matter of minutes versus a matter of days. One of the open questions was, if that's happening electronically through a consumer permissioned process, are we now touching the FCRA regs? And there was not really a great answer for that. So we actually commissioned a white paper from a consumer firm, a law firm in DC, and did some research. Sadly, there wasn't a lot of information around this, but the FCRA regs said, hey, if a consumer is providing their own data, the consumer is expressly not a furnisher under FCRA. So if you have strong consumer permission around that, you're not subject to furnisher rules. But now how do you implement that? Because it takes going to each bank in the country and walking through this reg to say, you don't need to worry about running into furnisher rules if you stand up a dev portal for consumers to access their data. So I think that's a pretty salient example of how we sometimes need to rethink the regs that have been on the books for a long time. Now, maybe one of the other challenges that we're working through right now is sponsor banking, and the only place where the regulators can regulate is at the banking level, not at the fintech level, for instance. And so the fintechs, as you mentioned, are working with their bank partners to comply with the regulations, but that's it starts to get difficult when you've got a lot of fintechs using a sponsor bank, and now the sponsor bank is essentially taking on somewhat of a regulatory role and having to maintain all the rules and regs with each of their fintech partners. So I don't know what the answer is. There's been some conversation about having a fintech charter that could be utilized, but I think we're a long ways from that right now. But there's definitely some questions that need to be answered in order to continue to expand the consumer protections, but also allow the innovation.
And if I can just add something about this from my experience at the AG's office, Virginia has a pretty strong rate cap now. We have a 36% rate cap, but at the time I was there at the AG's office, our state licensing, our state statute that would have licensed consumer finance lenders had some pretty strict regulations about inspection and compliance and regulation about prohibited conduct, as well as a rate cap. But the problem was that that statute was written in like 1930 something. So all of the contemplated supervision referenced to brick and mortar location, physical inspections of documents. So this was a statutory scheme that sorely needed to be updated. The problem was that the state regulator at that time said, well, we can't look at internet lenders, right? We had all these internet lenders and lots of folks were asking them to look at this problem and sort of figure out a way to address this. But the Bureau of Financial Institutions said, we can't look at them, we can't supervise them, we can't possibly do this or think differently, and so therefore we're not going to do anything. And so they didn't. They didn't license any internet lenders, but they also said that they couldn't enforce the laws against them because they couldn't give them a license. So what happened? Internet lenders flooded Virginia. There were discovery documents in private litigation cases that said, go to Virginia, make loans there, you won't get bothered by the BFI. The AG's office sort of responded to that in a way that developed a predatory lending unit. But it was just an example of how companies, internet lenders, really saw an opportunity where that statute was very out of date and they knew that it was going to be a problem and exploited that opportunity at the great expense of Virginia consumers.
So I think, one of the things when we talk about regulatory infrastructure and embedded finance, a lot of what you hear is kind of the side of outdated regulations because of technological innovation, almost from a lens constantly of dereg. But I think one of the things to think about is also the new risks created by the embedded finance relationship. And I think, one of the things that we consistently see and hear is the way in which you're turning kind of frontline, an example of like merchant credit cards, right? These are kind of the, like a big push, you keep hearing about how huge supermarkets, right, or huge, huge retailers would go out of business except for the revenue of its credit card. And I think one of the things when you start to dig in further and further is how much that person, when you go buy your shirt at Eccles or wherever, is actually acting as a salesperson for the bank. Mm-hmm. I think you see this on the medical debt side, where doctors' offices, dentists, the person when you're just trying to take your sick kid in, who's at the kind of front end gatekeeping about whether or not your kid gets seen or not, that person, from what you hear from advocates and litigation, there's like a whole sales tactics put in place to make that person a salesman for the bank. And I think, we have seen, and Chris knows this better than anyone, a ton of sales practices violations in this country that led to fake bank account scandals and otherwise. And I think we need to think a lot about how, if banks are going to use non-bank financial institutions to basically be their frontline workers, what does that mean about incentive structures? How do you police, the salesperson at Kohl's who has built into their, probably bonus structure, how many credit cards they take out in a day? So I think that's an important piece too. I don't think this conversation is only about outdated regs which don't let like financial innovation thrive. I think we need to be really cognizant about the risks that embedded finance has in terms of taking advantage of the merchant's relationship to the consumer and what that ultimately means.
Yeah, Seth is politely not naming the particular company he's referring to, which is Wells Fargo, that had, had a scandal where it had put so much pressure on its line bank branch employees to create new duplicative bank accounts that they were routinely going in and creating false bank accounts that nobody ever asked for. And the size of it was staggering about how often this happened. Could that also, the same kind of thing, happen in new and surprising ways as we have embedded finance? It's a really great point. Well, I'm gonna. You've all heard so many of my questions today after interviewing Director Chopra too. I'm so sorry, Commissioner Rudy. I didn't want to cut you off there. I didn't realize. Please.
Yeah, I'd just like to follow up on a antiquated regulation, if I could.
Yeah.
One that's causing a lot of pain points in the industry right now, in our depository institutions and ultimately the fintech companies that partner with them. The Bank Secrecy Act under FinCEN. Those regulations were written at a time where they didn't contemplate, the online lending structure and the third-party partnerships and who was going to pull the data and who was going to do it. So we have federal examiners now that are trying to interpret that statute. FinCEN does not have boots on the ground that can implement these regulations during an exam process. So the state and federal regulators are doing that for them. Some of the federal regulators are taking an enormous amount of time to read the regulations and try to find gotcha points, if they would, within the law. So there's a couple of them, like the consumer has to fill out the application. We have some fintech companies that, like say you go to Eccles and they might offer you a credit product, and you can accept that, type in your social security number, do whatever to accept that loan. You get all your disclosures electronically. You can accept those online. And is it problematic? Sure, because it may be over your phone, it may be over a 4-inch screen at the register, whatever. But now, arbitrarily, to some degree, I believe that, federal examiners are saying, wait a minute, that consumer didn't fill out that application from line 1 to line 40 by themselves. They signed that was accurate and correct, but they didn't fill it all out themselves, so therefore it shouldn't be allowed. Or they only supplied the last 4 digits of their social security. They should have had to input the whole number. So there's little technical differences that are very detailed in the old regulation. It doesn't contemplate, the modern way of getting a loan or providing credit to people in sometimes a convenient manner and sometimes in a compliant manner. So I think they should look at that.
That's a great point. Yeah. Thank you. Well, I'm going to turn to some really great questions online that have come in. I'm going to start out with the one that has been crowdsourced up to the top. You can vote for which question you think is the one that we should talk about. And the top vote getter currently is, are some of these embedded finance features just ways for merchants or landlords to push vendor costs onto consumers? And does this create reverse competition on the vendor fees because they can now kick back a share to the merchant? Anybody want to take a stab at their reactions to that?
So I'll jump in quick. So I think it raises a good point that I've been swirling around in my head, and maybe the person who asked the question can help with, right? I think one of the things you see on a lot of kind of the back-end embedded finance on the rental payment processing fees or otherwise is this idea of all of a sudden you're charged a fee for something that you feel like used to just be the cost of the product, right? You have this sense that when we were growing up, right, there was never the fee schedule for anything associated with the problem was somehow another auxiliary cost. And this debate goes around Washington a lot, which is well, shouldn't they at least be able to recoup the cost of X? Or shouldn't they at least be able to charge the people who are using this service? I think the real issues around that, again, come up with everything Director Chopra said a lot more artfully than me about trying to drive front-end pricing. I think the other logic, which is hard to get your arms around, is where does that logic end, right? You talk about shouldn't they be able to charge a fee if they are incurring an ACH fee, and can't they pass that along, right? But businesses incur expenses all the time to deliver you a product. How do you draw the line in terms of one that seems like something that you could recoup in the back end way against a particular segment of people versus one that should just be the cost of doing business? And I think that's where a lot of the junk fee work is kind of extending out. And I think to the point of the question too, I think that's where there's a ton of interesting questions for law enforcement and regulators. A lot of times, whether it's Taylor Swift or your utility bill, what they're saying is a payment processing cost is often does not seem tied to the actual cost of processing a payment. And where is that additional money going? How should you think about something that is articulated as a processing fee if it is decidedly a lot more? Are there kickbacks in the process? I think the question, both from a policy perspective and from a law enforcement perspective, is dead on.
Well, you want to chime in?
I'll just
Yeah,
take
please.
a quick stab. It's a very interesting space to me, but your example is a good one on what is the cost of doing business. And I think, if we look to credit card costs for merchants, it's kind of a decent example in the sense that the merchants have kind of borne that fee. And when there's lack of competition, like when I do pay my utility bill, I only get to pay that to one vendor, and they happen to be the one that charged me a credit card processing fee. When I do go to the merchant, they generally do not charge me a fee to process a credit card to buy the services. So I think competition comes in and helps solve that in a way, but it's on some of these services like rents, it's so new that we're starting to still try to figure that out.
That's great. Maybe, I don't know if Erin, if you, I'd invite you to respond to this if you'd like, but that's okay if you don't want to. It seems like it is in some respects responsive to your comments. One of our participants asks, doesn't speed, blending, and convenience for consumers in completing multiple transactions through one site advance the overall economy by expanding commerce?
So I think the question actually sort of proves the point about some of the harm of blending these two things, right? Because it's so fast and because you're not necessarily separating one out from the other. So I think consumers do want faster payments, right? I mean, Venmo and peer-to-peer payments developed for a reason. People wanted like an easier, faster way to do this. So I get that. And Chris, acknowledged before that there's some antiquated pieces of the puzzle here that could be updated. But with that speed, there's a pretty significant expense, and I would posit that one of the most dangerous ones is data harvesting. When you have an embedded finance product, that company is getting access to all sorts of information that they wouldn't otherwise have had. And then there's the secondary question to that is, what are they doing with it? The money that they're getting from you from that transaction is not the benefit for them. That's not the most valuable part. It's you. You're the benefit, your spending habits, the data that they're able to collect from those transactions. And then when you're putting all of that information in the hands of companies that are already pretty big, and then allowing them to keep growing on themselves and capitalizing on this data and getting an even bigger piece of the puzzle, an even bigger piece of the pie in our economy, I don't know that that's great for commerce when we have a few big companies that dominate it primarily through this data harvesting. And as we see these companies kind of creep more pervasively into something where they have not traditionally been a part of it, there's some real harm there and real opportunity for risk.
I think one of the reasons why I think it's so important we're having this conversation here, and it's something that Erin mentioned before too, is that there's this phrase like bandied around almost as if it's just like 100% intuitive to everyone, which is we should keep a separate wall between commerce and banking. And I think that we need to articulate why that is so important rather than just take it as a given. And I think this is a blend between consumer protection and antitrust, and kind of all of the things that you guys are trying to do here at Utah, because there are some incredibly powerful merchants in this country who are also, I think, now past the age of dabbling in consumer finance and especially payments. And I think one of the things that I think we should all be worried about is the idea in which you're going to have the largest merchants in America have vested financial interest in the financial products that are used in their platform, whether because it's their own products, whether it's because it's their way to reduce interchange fees, whether because they're getting a cut of the credit product. And what does that mean for overall competition if you're going to an exceedingly large marketplace, and when you log on, either because it's a forced transaction through theirs or there's tricks and traps which drive you to their unique payment system, what does that mean for ultimate competition in the payment system, which we want to be faster, more secure, less, data harvesting. And I think this is like a very, very live issue that I know we think about all the time, which is what does the future look like where the largest companies selling goods in America are also the ones trying to get you or force you to use their products?
That your comment naturally segues into one of the other questions submitted by panelists or from participants. In terms of fintech and consumer access to credit, do you see the role of split payment companies or buy now, pay later companies like Affirm, Afterpay, or Klarna as generally consumer friendly or generally consumer harmful? It's a tough question.
This is a tough question.
It's a fair one too, right? I mean, go ahead. I think I interrupted.
Yeah. I mean, obviously the Bureau's doing a lot of work on this. I know Seth is going to chime in. And it sort of alludes to something I said earlier, which was that consumers want faster payments, right? Some consumers are using buy now, pay later for large expenses that maybe they couldn't otherwise access. And it's pretty clear that people use these products. The CFPB's data shows like a large percentage of folks have interacted with the buy now, pay later product. But there are also a lot of risks that happen with buy now, pay later, one of which is that there's a pretty consistent overlap with like overdraft fees and credit card late charges because of the way that it alters your sense of affordability when you're engaging with one of these products. When you're buying something that you weren't necessarily planning on splitting into 4 payments, what does that mean when you then have to make that decision and you're doing it right then? Is it really encouraging the best decision making for consumers who are thinking about these things? There's also been a lot of issues with error resolution. What if you have to, and the CFPB is addressing this with some of their guidance, but consumers have reported a lot of issues with what if they need a refund? What if they haven't finished all of their payments and the product is a piece of crap and they want their money back? What does that mean for people? So sort of interspersing this financial product into an otherwise traditional purchase, there's just some things to really think through. And, we're really grateful to see the CFPB's guidance on this to help with some of these questions.
I think the answer is yes. The consumers have spoken, they love the product, so it's probably doing some good. And then there's some harms that are clearly coming from this that need to be addressed. So as there's new product development, there also needs to be new consumer protections, but I don't know that means that we want to move away from the new product development. So yeah, it's very, very, very popular product. So I think that, we've got to figure out how it's going to exist.
Yeah, and Erin, I agree with most of what you said. Those protections need to be there, but at what point do we impede people's freedom of choice and their access to those products if they need them? If you have, your tires are worn out and bald and you need a new set of tires and you don't have $1,000 in the bank account, a buy now, pay later product may be a very good resource for you to get those tires so you can go to work, take your kids to school, do whatever you need to do. And I know we probably overemphasize disclosures and the need to have clear, concise disclosures for all those financial service products, but disclosures do help a lot. But a lot of consumer education needs to happen because many consumers, especially if they're put on a short leash of making a decision or trying to do it on their iPhone or at a cash register, of really reading those disclosures and knowing what they're signing up for, whether it be an open banking product where they're finding out more about the consumer and embedding products at them, or whether it's just knowing what the fees are before they sign up for the add-on products.
Can I maybe add one more thing to that's I think interesting in especially embedded lending? The BNPL lenders are not contributing that data to the credit bureaus. So to the extent that somebody wants to help build credit with these products, it's unavailable. And I think we're going to see more and more of that with embedded finance. And, it kind of goes back to the data question. It's not just how is data being used to make me want to buy a product or service or market to me. But it's also like, how can I use data to my benefit? And I think that's part of what the question is. Like, we need a data law in the United States. But what we're seeing is lenders have figured out how valuable that data is, and they don't want to give it for free to credit bureaus anymore. And that marketplace has started to already develop.
So I think just to echo, though I think I'm going to get the phrase wrong that the director said, I think in a lot of ways the Bureau has tried to be tech neutral and tech optimists. Was that, I think, the right phrase? And I think one of the fascinating things, I was at the Bureau and then I left and then I came back, as Chris mentioned, is just how much cooler payments is. Like, all of a sudden, like, we used to joke in the beginning, they used to post payments jobs and they couldn't get anyone to apply. And now it's like what everyone wants to do. And, I think one of the things that we have tried to really do is kind of be like branding agnostic. Like, industry has always liked to come up with like a new way to describe what they're doing, whether that's buy now, pay later, earned wage access. And I think like what you're really seeing, which I think, speaking for myself, you're morphing to a very different world than just a few years ago, where people, when they make point of sale payments, are going to have a multitude of options in a way that is much different than it used to be, where you paid with cash or you had one credit card. And I think what you're seeing is whether it's like online through like a digital checkout that you kind of build and keep, or a company that you go to for the first time presents you with options, people hopefully will have a much better selective of choices, either if you have enough money to pay and the way you want to pay, or if you're a buck short, how do you want to cover it? Like, do you want to do buy now, pay later? Do you want to do an overdraft line of credit? Do you want to take out an installment loan? I think the goal is to make those products actually on a level playing field in terms of consumer risk and what the consumer understands. I think at the last panel, they kept asking, why do we keep having on here like a competitive marketplace? And I think the idea is that the products should compete because it's the product the consumer wants, not because the consumer was tricked into it, or that one business had a leg up because even though they were essentially doing the same thing, they were able to purportedly escape the rigors of dispute resolution or ensuring that the goods were legit. And I think that's like the ultimate goal, hopefully, is to the extent there are more options for people, that people actually are able to make choices based on reality, not on regulatory arbitrage, not on old, outdated rules which pull people in or out as a credit product and the obligation that those comply with, but good, honest competition in which if the BNPL product plays by all of the same rules as the other products and is the better product for the consumer, that's a great outcome. But if they're competing because they have a lower cost of capital, because they purportedly tell their investors they don't have to comply with this section of Reg Z or that section of Reg Z, I don't think we want that to be the outcome for anyone.
Yeah, I mean, it seems to me that sometimes the innovation is there because it's providing a superior product, but the buy now, pay later product itself was sort of born of a pocket within Regulation Z that doesn't require disclosure of interest rates if it's no finance charge and 4 or fewer payments, which is why they break it up into only 4 payments and don't have a nominal finance charge. Don't have to do a Truth in Lending Act disclosure. That also, I think, probably historically, you could correct me on this, I'm not sure I've got this right, but that also means that you can't assert your claims or defenses that you would normally have against a merchant in the way that you could if you paid with a credit card. So if you buy something with a credit card, and like say you buy a bicycle and the bicycle doesn't work, there's a warranty claim. If you haven't paid off the debt on your credit card, you are allowed under the Truth in Lending Act since the 60s or thereabouts to say to the credit card lender, the bank, I'm asserting my breach of warranty claims against you, bank, and then you can go and reverse the charges against the merchant. It's not clear to me that is a protection that exists within the buy now, pay later space. And also, you don't get the benefits of the positive credit reporting, or for example, the card acts limited ability to pay standard, it doesn't seem to, I don't think that applies to the buy now, pay later market. So that being said, though, there's a lot of really positive stuff about it. People like it. It's popular because it's a free product, right? Assuming that you pay on time and it has some real value. So go ahead.
Erin would say it's not free because of the data capture, but she said it a couple times, so I was going to step in for her.
And it's free if you make your payments on time. And when you're using buy now, pay later for like groceries, there's a question about whether you're going to be able to make those payments on time. And if you were not expecting to finance it and then you did, planning that out can be a little difficult. And when you are in that purchasing process, your ability to think about those things down the line, there's some questions there about whether it's really free. And I think there's also research about some of these buy now, pay later companies getting a significant amount of revenue from late fees.
Mm-hmm. For sure. I don't get next question up in the queue that people have voted for is a tough one. I'm not sure I'm going to be able to answer it, but how does the U.S. compare to other countries when it comes to embedded finance? And are there regulations we can take from those countries that ensure a more successful implementation of this transition to an embedded finance world? Any comparative legal scholars want to weigh in? Yeah. Yeah, it's a hard question. I mean, I know a little bit. I mean, I know that right now the European Union has the Commission has a directive on consumer credit that's trying to facilitate cross-border financial services, and they have outlined, page after page of different types of consumer protection laws that each of the member states are supposed to build into their their state consumer protection regulations. But the overall goal of it is to create more portable cross-border financial services offerings. I suspect part of what's motivating that is exactly the kind of thing we're talking about, incentives to have more embedded finance in Europe. They do tend to have much more aggressive data privacy regulations in Europe than we have here. They also tend to have more aggressive usury regulations than we have here. But they also don't have class action lawsuits, and their enforcement environment is quite different than ours is. I know that the East Asian countries, Japan and Korea, they tend to have much more unified regulatory environments. They don't have 50 different states going in 19 different directions in this patchwork that's constantly evolving and so confusing. So I think they've been much faster at building a lot of these financial services into embedded finance in more creative ways. They're moving. I think they're quite a ways ahead of us. That's just my impression, but. Let's see some other questions that have come up, and feel free to anybody on the panel. I'd like to invite you all, if you have questions for each other, oftentimes it's the funnest thing. If you want to invite that too.
Oh, never mind.
Oh, Dr. Glick, did you have a question? Oh, you want to yell it out, and I'll repeat it for folks at home for you.
Do you think embedded finance as a whole increases inequality?
That's a great question. So the question from Dr. Glick from the University of Utah Economics Department is, do you think that embedded finance as a whole increases economic inequality? Is it good for poor people or bad?
Boy, we're really getting the easy questions today, guys. I mean, geez. Part of the thing with embedded finance is it is everywhere, and it is in so many different financial products, non-financial products that are financialized through this process. So there are certain products like peer-to-peer payment where we know certain populations of folks who are like low income tend to use them more, or they tend to rely on that as their banking service. So when these non-bank providers do not have the same regulations, safeguards that apply to traditional banks, the people who I think are more at risk when something goes really south are the folks who are relying on them to be a bank because they may not have access to a bank otherwise. So in that sense, I think it could disproportionately impact those folks. But, I don't want to make the other side's arguments for them, so I'll stop there.
I think just one of the things, it's a great question. I think, one of the things that I think has to be part of the discussion, I think, especially like at a academic institution and with business school people here, is thinking about what it does to the merchant business relationship to their own consumers, right? I've been I don't know why I focus so much on big box realtors, right? But, you know, if you used to think about being able to go to, you know, Kohl's or Bosco and get a good workman $15, $16, $20 shirt, right? And just pick it up, pay for it, move on, go to your shift. What does it mean now if there's all of these mismatch incentives where that company doesn't even necessarily need to make a dollar on that shirt, and they don't seemingly really care that what you're getting with that shirt is a 39% interest credit card debt that will be exceedingly hard for you to ever pay off. And I think that I hijacked your question about, you know, is this good or bad? But I don't know what it means on the, I don't think we have also thoroughly thought through the relationship between the customer and the company that's embedding the finance in it, right? Like, what does it mean for that relationship long term if they're basically just viewing their customer as either the sole way that they're going to drive revenue or subsequently monetize? And I don't know, I just think it's something interesting to think about, especially when you're thinking about people at the lower end of the economic scale.
Well, we've come to the end of our time. A lot of great questions we didn't have time to get to in Slido, but thank you everybody for having this interesting and important conversation, and for all of you for joining us. Please join me in giving our panelists a round of applause. So we're going to take a short break, and we'll be back in, I think it's 10 minutes. Thanks, everybody.